Hello again. In our last video, we went over inflation and covered a little bit about Secure 2.0. Here, I want to go over the fixed income markets, the bond market, and what we expect in 2023. And again, I promise there's a reason behind all these weird pictures, but we'll get to that in the third video. So here we're looking at the fixed income market dynamics. And now there's a lot to look at here. This chart's from JP Morgan. And essentially what we're looking at here in this column is the return that we saw in these different bond positions in 2022. And this column right here is showing where the interest rates started on those positions in 2022. So essentially we're looking at the end of 21, the end of 22. So last year we saw that even if we were looking at a 5-year treasury, you lost roughly 10%. And the reason for that was your position was yielding 1.26%. By the end of the year, it was up to 3.99, essentially 4%. So yes, you made your income that you were expecting, but the value dropped tremendously because interest rates went up by nearly 300 basis points. Even if you owned a 2-year treasury, you saw your values drop. Your total return was minus 4%. If you were out 30 years, you saw your values drop over 30%. The aggregate bond index dropped by 13%. The yields went from 1.75 to 4.68. This becomes really, really important when we start looking at our returns going forward and what these numbers mean. So essentially, if we're looking at just owning the aggregate bond index, and let's make this math easy and say that this number was 5%, what this tells us is that over the next 5 years, if the aggregate bond index has roughly a duration of 5 years, actually, let's just make our math easy and use the treasury. So if we use the 5-year treasury, this is telling us that over the next 5 years, we're going to make 20%. Basically 4% every year for 5 years. So at the start of this year, or I should say at the start of 2022, the yield was 1.26. So you know over a 5-year period, you were going to make roughly 6%. So at the start of 2022, you were making a collective 6% over 5 years. Now you're making 20%. So the dynamics of the fixed income markets have changed tremendously, and there's actually yield to be had in these markets. So if you had $1 million invested into the U.S. aggregate bond index at the start of 2022, you were making about $17,500 a year. By the end of the year, and you invested $1 million, you were making about $46,800. Again, a tremendous shift in where things were versus where things are today and where we'd expect them to be going forward. What this also means is that last year we saw massive declines in fixed income that we had not seen historically. And so because interest rates are now significantly higher, this chart on the right is showing us what happens if we get a 1% increase or a 1% decrease in interest rates. So again, looking at the aggregate bond index, which sort of approximates where we are with our portfolios, if interest rates were to go up by 1%, you would see that your account value is down by 1.5% on the year. So again, interest rates go up, bond values go down. But we're not talking about the cataclysmic shifts we saw last year, where portfolio total returns were down 13%. Here we're looking at in a scenario where interest rates on the long end of the curve, 5, 10 years, kept going up, we would see that the portfolio was basically looking flat on the year. In the scenario where interest rates went down 100 basis points, it would look like your portfolio had a total return of 10.9% on the year. Obviously, I'm recording this on February 2nd, and interest rates have come down since the beginning of the year by about 50 basis points, and we're seeing that the aggregate bond index is up about 4% and change on the year. So I suspect that on this year, we're closer to this side than we are to this side, but certainly anything's possible from here forward. Now, when we're looking at the historical figures about what we can expect from bonds, this chart is just showing us that bond funds have never lost money 3 years in a row. Obviously, there's a first time for everything, but when we look at the historical context of the previous periods where bonds lost money 2 years in a row, we tend to have pretty good returns in the third year. So again, in 2021, bonds lost money. In 2022, bonds lost money. What can we expect in 2023? Well, again, going back to this chart, we're saying that if interest rates were to come down a little bit, we would expect the aggregate bond index to be up 10.9%. That is potentially a fair assessment. Maybe we're down or maybe we're up a little bit less, but overall, I would expect to see that the bleeding would stop. I don't expect to see negative returns like we saw in 2022, again in 2023. In fact, I suspect the returns should be pretty good. And again, when we're looking at bonds, it's not really what they do over the next 1 year period. When we're looking at a bond portfolio right now that has a 5-year duration and it pays 5%, I know with confidence that we are going to make 25% over the next 5 years. If interest rates go to zero tomorrow, it's going to look like we make 25% in the blink of an eye, and we're going to feel like heroes, but that means that in years 2, 3, 4, and 5, your portfolio is going to look like it makes zero. If interest rates stay flat, it's going to look like you make the same amount every year. You make roughly 5% every year. If interest rates go down, or I should say if interest rates go up, it's going to look like your bond portfolio stays relatively flat this year, but then in years 2, 3, 4, and 5, you make the same 25% you were expecting, just crammed into a shorter time period. So that's kind of what I expect going forward, but here's some more historical context to give some credence to those numbers I was laying out there. In the first video, we talked about the Fed ending their rate raises. Historically, the end of the Fed raising rates, or the last rate raise, has typically been good for both stocks and bonds. So here we're talking about, this chart just shows us the last Federal Reserve rate increase. It gives us the date that occurred, and then it shows us the next 12 months of stock returns and the next 12 months of bond returns. Obviously on the stock side in 2000, the next 12 months were negative, so there's no telling what's going to happen. I don't want to indicate that this is a surefire thing. The stock market is absolutely going to go up and the bond market is absolutely going to go up. But typically, once you see the Fed stop raising rates, interest rates start to come down or at least stabilize, in which case your total return starts looking much, much more attractive than it has in previous years. So again, with the assumption that the Fed stops raising rates at some point earlier this year, we should see that our bond returns over the following 12 months look pretty good. Now this chart is just telling us not to follow the flows, because this comes to mind a lot of times when you see articles about investors are fleeing bonds or investors are running into bonds. That is a very, very counterintuitive is not the word I'm going for, but basically when investors are putting all their money into bonds, we need to be a lot more cautious. When investors are fleeing bonds, bonds typically do better. So what we're looking at here is annual bond flows is showing that in 2021, bond flows hit a historic high. And of course, we know what happened in 2022 was that bonds got crushed. And what you see when bonds get crushed is that investors fled bonds and went to cash. Well, obviously, they could have gone to stocks or cash or anywhere else, but I know from other charts that most of the time they've gone to cash. And so what this tells us is that the average 1 year performance after the top 10 inflow years, bonds have produced 1.7% returns. On average, 4.5% is the bond return. But in the 1 year performance after the top 10 outflows, meaning the top 10 periods where people were leaving the bond market, bonds tend to do really well. And the reason this happens is because when someone looks at their performance in their 401k, when bonds have gone up in value, it looks like, oh my gosh, I'm an idiot for not getting into bonds. They were up 10% last year. What they don't realize is that means that interest rates have gone down. And with bonds, prices don't go up forever. The yield is what the yield is. If you buy a bond that has a 1% yield and a 5-year duration, over 5 years, you're going to make 5%. Sure, interest rates could go down further and you could see a quick spike, but your return is what your return is. And so the other thing happens where interest rates go up, I should say, interest rates go down, the values go, I'm sorry, I'm all confused now. When values go down like we saw last year because interest rates have gone up, people look at their statements and say, oh my God, I'm getting crushed on bonds, I'm losing all this money. Well, just at the time when bonds are looking attractive, people start fleeing them and selling them and moving to cash. So again, we do not want to be following the market. We want to be going against the market. So when we see a lot of fund outflows, that's a pretty good indicator that the bond market is actually going to be in a pretty good spot going forward. and that our returns should be pretty attractive in that space. That's it for this video. In the final video of this presentation, I'm going to go over the equity markets and then close out by making some other thoughts on things you can expect to see in 2023. Thanks. Look forward to talking to you soon.